Joining us, Patrick Mueller is RFC and president at Bella Advisors. Patrick, good morning. Thanks for being here.
Good morning. Thanks for having me, Oliver.
Stocks have obviously been getting a hit here. Do you see any relief on the near-term horizon?
I don't think so. I think we're going to continue to see this volatility throughout the course of the year, unfortunately, because we've got this new administration that's coming in and it's making so many changes, and the markets don't like uncertainty. They like certainty and to know what's going to happen in the long term. And so we're just not going to see that with all the tariff talk and all of the changes that are happening. I think we're going to see a lot of this volatility is just kind of like a normal day today, I think, that we've been seeing so far this year. So we're going to continue to see that, I think.
What if we're certain that there's going to be uncertainty? Does that flip the script around? If we just know that there's going to be things we can't predict and maybe we just focus on what we can predict, isn't that what investors are supposed to do anyway?
Absolutely. I think you got to, think like Warren Buffett right now. He's sitting on over $300 billion in cash right now. And how often does this guy get it wrong? He doesn't get it wrong too often. So when you think Warren Buffett, buy companies where you can basically fall asleep and 5 years from now, they're going to be doing well. So it helps you kind of ride through this volatility and stomach this volatility. And unless you're retiring today, you should be thinking a much longer time horizon. So we should expect more of this uncertainty and volatility moving forward for sure. But I think as we start moving along and the ships, the country's like an aircraft carrier. So it takes time to steer that ship. So I think we just got to stay the course and just know we're going to go through some rough waters, but we're going to be, just fine, I think, moving forward.
I like the Buffett reference because that's kind of what I was hinting at, is just, buying good stocks, cash flows, and holding, but then he's got a lot of cash on hand too, so suggesting maybe that even he's a little puzzled. So I think that's a very fair point.
Absolutely. People should be thinking of buying things at a discount right now. I mean, look at Tesla. Like whether you like Elon or you don't like Elon, very polarizing right now.
Yeah, 40% off.
Tesla is taking such a big hit. I mean, it's time to maybe take some of that cash and start buying some of these companies up at a discount right now.
When you look at the discounted stocks, a lot of it is obviously big tech. Do you envision the market's recovery as being one driven by those big seven?
We'll definitely see that as a driver moving forward because the earnings have been really good. So they're getting unfairly beaten up right now, I think. But tech with AI being such a big force moving forward, that's really going to be powering the tech sector. And I think we can continue to see that from the big seven here moving forward. I mean, you can't bet against those companies. I mean, long term, they're going to do well.
How about how do we diversify though? If we're an index investor and we maybe don't want to be super tied to these things like we were 3 months ago. You live by the sword, die by the sword, and it's been pretty good living for the most part. But I think a lot of people woke up that they were way too concentrated in a few big names.
Absolutely. And, think of things that are maybe, not on the front headlines. When it comes to energy, I think we're going to see a big move in energy moving forward when it comes to powering all of these different AI companies. We're here in Atlanta and we've got all these different data companies and data storage companies here in Atlanta. And you got to power that. Like the demand is going to be so high for that moving forward. And then things like healthcare. Healthcare was a sleeper last year. And I think we're going to see a strong move this year with different healthcare companies. Like through this volatility that we've seen the last couple of months, you've seen companies like Merck do really well and the earnings are really strong. So that can be things to look at. And I think silver is also a good place. Everybody should be diversified, just out of the stock market and looking at things that are out of the stock market. So the earnings on gold and silver have been great. And as things are fearful and things are volatile in the markets, it's a very fear-driven, gold's very fear-driven. When there's a lot of uncertainty, people probably tend to buy more gold, maybe more shotguns, canned goods, right? Storing up. And so that could be a good move moving forward.
Gold is just shy. We got through 3,000, just shy of its recent highs, but it's been really impressive. Do you think as the price goes up, momentum for gold builds, it should be a bigger part of someone's allocation?
Absolutely. Gold's a great place. It's a good staple long term just to be holding on to some gold. And I think we could see it moving up to, as high as, $3,300. And another thing to take a look at is silver as well, because you've got all the demand right now from solar and from electric cars, and there's going to be a continued demand for that moving forward. So we've seen the price of silver, moving close to, the price of gold, the returns over the last year. So don't sleep on the silver. But I got a fun thing for you. So we had some clients that bought some gold, right? And they purchased like 25 grand, and they got the physical gold. So they got like 17 gold coins, but they got 11 cases of silver at their doorstep. So if you're storing that stuff, be prepared for that if you're buying silver.
Yeah, make sure you got room in your garage. Make sure you've got a garage. Robert, I guess if gold breaks out, which it has, then silver naturally follows. I've been kind of waiting for that to happen. It's stuck right under its 52-week high. Do you think at this point, with the complications in stocks and the other stuff, that folks should be pumping up their precious metals allocation? And is there anything else that fits in that sleeve of the portfolio? Any other alternatives that you like?
Well, everybody should be properly diversified. And we work primarily with folks who are retired or maybe 5-10 years away from retirement. So we take a pretty cautious approach to things. So people should be taking a good rule of thumb that take your age, and that's the percentage of your money that you should have safe and protected from market losses. And so that way we're never taking too much risk as you're getting closer to retirement. It's so important that if we go through a big downturn, right, that's not really going to affect you. But as with anything, I don't think anybody should be owning more than probably about 5% of their portfolio in gold or precious metals. But I think it's a good piece that can help during rough periods of time.
Well, my guests have been talking about alternatives in the form of private market stuff. Do you like your clients in alternatives, private credit, private equity, anything like that? Does that play an important role?
Well, one of the things that we're seeing right now that I think is going to be huge is there's so much credit card debt right now. It's at all-time highs, and something I thought was really shocking that I read about recently. You got DoorDash that is starting to do buy now, pay later. People are going to be financing their fast food, which I think it's a little nutty. And there was $75 billion of buy now, pay later purchases for last year. And so that's staggering. It's going to be interesting to see how that plays out. But, inflation has been such a factor. I mean, the price of everything has really doubled in the last few years. So if somebody's making $100,000, their purchasing power, it's only like $50,000 right now. So people are really struggling, even though we're not really seeing that a whole lot right now. And that might just because of, all this overspending that's happening right now and all the debt that's piling up. So at a certain point, we're gonna see that tank.
Patrick, last point is thinking about bonds. Do you trust them? Do they work for investors? They've been working pretty well lately, but folks are still scarred. Do you find people had to repair the bond side of their portfolio after 2022?
It's tough. It's just really tough. It's been on a steady decline. And even though we've seen interest rates coming down with the treasury debt that we have, I don't think we're going to see too much in positive moves that way. But the important thing that people need to know when they're buying bonds is that you want to own your bonds directly, because there's going to be a maturity date. If you're taking out for 1 year, 3 years, 5 years, own that bond directly. Otherwise, if you're owning it in a bond fund, then it's going to be completely driven by interest rates, right? There's no maturity date, so there's no date and time when you're going to get your money back. So that can be a much different place to be in. So I would just caution people when it comes to bonds. It can be a good short-term place for treasuries and things of that nature, but I would own the bonds directly if it were me.
All right. Patrick, thanks for your thoughts. I think I accidentally called you Rob.